It's another edition of the Trading Tips video newsletter, teaching you how to become a successful trader today. This video newsletter is brought to you by PortfolioCrafter.com.
Welcome to this edition of the TradingTips.com video newsletter. In this episode, we'll be looking at the biggest financial news item in quite some time, Facebook's forthcoming initial public offering, or IPO. Is this the start of a new tech boom? Facebook is an 8-year-old company. It has filed an IPO out of necessity after coming up against an SEC-imposed limit on private investors. As part of filing its IPO, Facebook was forced to disclose financial information for the first time. In doing so, Facebook announced that 2011 revenue came in at $3.7 billion, generating $1 billion in net income. There are 483 million daily users of Facebook. Its IPO is expected to raise $5 billion in cash for the firm, with it selling off approximately 5% of its shares to the public. This would give Facebook a total market valuation of $100 billion. $75 billion is being set as a low-end estimate. This is the face of Facebook founder Mark Zuckerberg. He owns over 28% of Facebook's shares, and with a $100 billion valuation, this would make him a billionaire 28 times over. At just 27 years old, Zuckerberg will likely become the 9th richest man in the world, the 4th richest in America, behind only Bill Gates, Warren Buffett, and Oracle founder Larry Ellison. Facebook has made Zuckerberg very rich, but will it make you rich too? Probably not, at least not right away. At least if you're not an institutional investor or someone with extremely high net worth with an insider connection at a major brokerage firm. That's because of the way IPOs work. First, the company files a prospectus, also called an S-1. Next, the underwriter of the IPO, in this case Morgan Stanley, sells shares at the IPO price to major institutions like mutual funds, as well as extremely high net worth individuals with insider connections. Then and only then, these insiders turn around and sell shares to the general public, usually at a markup. In other words, IPOs are in many ways a scam for individual investors, a system in place to make the rich richer. Sometimes individual investors do get a chance to purchase IPOs at their IPO price. Google, for instance, insisted on allowing this. The brokerage firm Fidelity often arranges for its individual investor clients to be able to buy shares at their IPO price. But they have not said whether or not they will do this for Facebook, and it's unlikely they will. That's because Fidelity normally does not have access to IPOs underwritten by Morgan Stanley, which is the primary underwriter for the Facebook IPO. TD Ameritrade and Charles Schwab said they would not be offering the IPO. Maybe this is all for the best anyway. After all, recent IPOs have not fared that well. HomeAway and Boingo Wireless are down 1% and 38% respectively from their IPO prices. And while Groupon is up 7.5%, it is actually down 18% from its closing price on the day of its IPO. On average, IPOs underperformed the stock market for their first 2 years. A recent IPO was Zynga, and as you can see from the left side of this chart, it flopped big on its IPO day. From there, it went even lower, before beginning a surge mid-January. What prompted this surge? The coming Facebook IPO. Zynga is the maker of Farmville and Mafia Wars. Its games are responsible for upwards of 20% of Facebook's revenue. People excited about Facebook's IPO are buying Zynga, but this isn't the smart money. Thus, the Facebook IPO provides the opportunity to sell Zynga into this strength before prices inevitably correct. There are some other potential pitfalls for Facebook. First, there's Google, which may better integrate its Android mobile platform with its Google Plus social network, and Google has much more power and influence than Facebook. Secondly, Facebook's ad revenue is tiny compared to Google's, its prime competitor. Facebook generated only 85% of its $3.7 billion from ads in 2011, whereas Google generated 96% of its $37.9 billion. Facebook's cost per thousand impressions, or CPM, is among the lowest in the industry, whereas Google's is the highest. The social media environment is fickle too. Remember MySpace? How about Friendster? As mentioned before, Facebook has some big competitors. One is Google, but also Twitter and Microsoft. And finally, the economy itself is weak. In conclusion, it's usually best to avoid IPOs. Facebook may be an exception to this rule, but it is very unlikely to be the start of a new tech or IPO boom. The real bit of interest for traders here is the possibility of playing on Zynga, buying ahead of Facebook's IPO and selling for a profit. We hope you've enjoyed this TradingTips.com video newsletter. Thanks for watching and good trading.
This video newsletter has been brought to you by Portfolio Crafter. Manny Backus designed Portfolio Crafter to be one of the easiest trading systems available on the web today. But don't take our word for it. Visit www.portfoliocrafter.com and access the free special report. It will show you how you can place profit-rich stock trades in just 15 minutes a week. Read the free report, and you'll understand how the easy money's made in the markets. To access the free report, visit PortfolioCrafter.com. Portfolio Crafter, another market-beating investment service from WealthPire. Take control of your financial destiny. View more Trading Tips videos. Visit TradingTips.com. Sign up for our free video newsletters and become a success.